understanding broke down. And so there's been some more active missiles being fired. We've seen prices go up about 5%. So we think we're looking at around $74 a barrel WTI. And of course, a lot of us at King Operating, and if you've watched any of our other webinars or shows, we are not fully surprised by the recent developments. I think there has been a lot of back and forth with the Trump administration, what's happening in the Middle East with Iran. So we're all just keeping our eyes on what's going on, seeing how this is going to affect the Strait yet again, and see how the supply is going to be affected moving through there. So of course, if you would like more information, there's a great podcast that Jay did on the Jay Young Show that is on YouTube. We had Dan Steffens on from EPG Energy, really breaking down, going through a lot of what he sees across the board as far as what's happening in the Middle East, also what's happening with supply, demand, all of that. So I would encourage you, if you want more information, to take a look at what's happening. Go check out that podcast on the Jay Young Show. You'll see with Dan Steffens. So, and Mark, with that being said, I kind of wanted to come to you and just talk a little bit. I know you spent some time in the Middle East, and we've talked about this before. So, what really makes parts of the Middle East so prolific in the oil and gas space?
Well, Rachel, I think I have to go way back to dinosaur time. And so you go back into the Mesozoic, and we're going to talk about 206 to 66 million years ago. And back in that period of time, the supercontinent was breaking up and an ocean formed called the Tethys. And that was a real shallow, arid environment that is really what created the source rock, the seal, and the reservoir for all of the Middle East. I mean, that's a real simplification, but that one event, which was a huge period of time, I mean, you were talking about, probably 40 million years. So it's not just like it happened overnight, but that is what laid the foundation for all the hydrocarbon that's accumulated there. And it wasn't until the 1950s that, thanks to BP and some other folks doing some exploration in Saudi Arabia, that a Guar field was discovered, which is supposed to be the world's largest oil and gas field. And depending on who you believe, it's going to make anywhere from 70 billion barrels to 100 billion barrels of oil. That's always a contentious issue, because it's got a structural underlaying, but it also has some variation in the sands. And they do some pressure maintenance. There's all sorts of things going on. So it's sort of a controversial issue in the world of trying to project the future reserves of the world. But it's without a doubt the largest field that we can point to, and most of it lies underneath Saudi Arabia. There's some other great fields there. One of the things I think is interesting, we talk about this, is I don't think we can get oil out of that Middle East through things other than the Strait of Hormuz. It may take us some time to do that, but there are other ways of piping it out. The one thing that would be hard to do, at least in my mind, is a lot of the LNG comes from Qatar in a field that they share with Iran. And that pretty much, I think, is going to have to come out on LNG tankers. But there's a lot of LNG around the world also. So I think there's plenty of sources for that. There may be some supply upheavals here and there, but I think we'll find plenty of LNG in the world. There's lots of gas in this country, all over the world. I don't know. We talk about the oil and gas being generated, and we think about it, a million years. That's hard for humans to put our hand around that. But anyway, the oil and gas in the United States, most of the oil and gas that we produce, not all of it, but onshore, is what we would call Paleozoics. There are some Mesozoics in the Rockies, but mostly they're Paleozoic oil. That means that they're pre-dinosaurs, back in the what they call a Carboniferous. Lots of coal beds, a lot of hydrocarbon was created from all that organic matter was deposited. And that's what really drives most of the oil and gas in the United States. And then until you get in the Gulf of Mexico, there you get some stuff that's really young, it being what we call the Cenozoic, so that we could even be looking at something, I think, from this Miocene age. And those are huge discoveries, but they're not on the scale of guar. So I read something online that if you compare the oil to be discovered, and please don't quote me this because it's been a while, but I think the oil in the Permian Basin, which is currently it can produce as much as guar, but the Permian Basin, I think I read, was going to be 20 billion barrels of oil. None of us really know, but that was an estimate, whereas guar could go as much as 50 to 100 billion barrels of oil. So that just shows you the scale. And plus, it's a different cost structure to produce it. I mean, we got to drill the horizontal wells and frack them and produce them, whereas over in the Middle East, it's a bit easier to drill those wells and produce them. They're drilling vertical wells. They are starting to drill horizontal wells now, and that's one reason why I was a little bit involved in going over to Abu Dhabi and meeting with some of the people from the Abu Dhabi National Oil Company. They were interested in trying to do some unconventional resource plays. And so unfortunately, they decided to go with EOG instead of with Hunt. So I didn't get to get involved in the actual development, but interesting point, they were really, what they were interested in was finding natural gas, which sort of struck me as odd because there's so much there, but they wanted, I think, some in their own territory. And that was something that they really focused on.
What year was that when they were kind of honing in on natural gas?
Well, I'm sure it's been going on for a long time, but I'm thinking that was 2017, 2018. And they had engaged with several companies, including Hunt, looking for some unconventional players in the domestic United States that they could join forces with and help develop these resources. And of course, we were all excited about going over there and looking for oil. And they really were pushing for us to look for gas. And the problem is that the gas resource was much riskier, in our opinion, than the oil resource. And that wasn't really what we were interested in. So it's an interesting area, though. A lot of oil, interesting, lots of great, well-trained people. ADNOC has a lot of very qualified professionals from all over the world, Europe, but a lot of them from the Middle East themselves. And so it's an interesting area, and and it's looking like the United Emirates, the UAE, which Abu Dhabi is part of, is actually becoming one of our closest allies in the Middle East, which is interesting.
You know, it is actually really interesting just to, and you know, you're just slightly older than me, but you know, just there's been a lot of changes, I think, in the last decade in the Middle East, as far as seeing friendships evolve, different relationships, you know, a lot more open tourism and just changes, which have been really interesting to see. And then watching, you know, the UAE leave OPEC was a very interesting move. So you know, and I think, again, looking at Qatar and, you know, what's happened with their natural gas refinery, like you mentioned, I think they're down about 70% of their production, last I heard, with nat gas. Does that sound right to you, Mark?
You know, I don't really know, Rachel. I really could. I'd give you an answer, but it wouldn't be a very informed answer.
That's absolutely okay. That is what I heard last time. I know they've taken some real hits. And again, I think I got that probably from, I don't know, one of my resources, or maybe Dan Steffens, and he mentioned that, and he mentioned how much time it's actually going to take to rebuild those facilities. You know, some of those refineries, you don't just pop them up overnight like a tent. You know, I'm just going to take some time over there, but it will be interesting. I agree with you. When I was listening to another oil and gas podcast, they were talking about how future plans, I think, you know, when you're looking at Qatar, even the Saudis, and the Saudis have a pretty good pipeline they've been able to get oil out of. I mean, a little bit slow for them, but they've been able to get oil out. I think a lot of those countries are looking at options to bypass the strait in general and not have to deal with it in the future. Is that what you're kind of hearing, Mark?
Yeah, well, I think so. You know, we've got, of course, one of the fellows that works with us who spent a lot of time in Iraq, one of our VPs, and there's oil that can go out through Turkey, and so that's another avenue of getting oil out of the Middle East, is to go to the north through Turkey and not even have to deal with the Persian Gulf. So so that's an interesting. There's a lot of, and I will say, being a senior citizen, as you pointed out, that there's a lot of ways that the oil and gas business can, because capitalism works beautifully. That's not intended as a political comment. That's just been my experience. We find a way to make money, and we do it over and over. That's why the United States was able to become independent as far as oil production, which was, when I went to college, people were talking about how the period of the United States being a major oil supplier was gone. And boy, were they wrong.
Yeah.
So, and that's just because
we're Americans. Give us a challenge, right?
Well, so the rest of the world's pretty good. I mean, the French with Total are very good at. There's a lot of places in the world that are very good at finding oil and gas, but I think that's true. I think the way that our industry is created here in the United States was particularly and the fact that mineral ownership is private, largely, not all governmental. It really helped drive the unconventional resource business. Really, you to go back and do a real study in it, but since the early days of the Barnett with George Mitchell Oil, and how they started out with vertical wells, they started experimenting with short horizontals, and pretty soon they produced this gas from rocks that, when you looked at it, you wonder, where in the world is this coming from? It was a source rock, and so there's a lot of things that happen because of the individual entrepreneurship of people that in this capitalist environment. And,
I completely agree with that. I think another interesting thing about the Barnett Shale and them was when they started drilling those gas wells and go, working on the horizontal fracks. I think they also changed the frack fluid, correct?
Oh yeah, well, the science of fracks has changed dramatically. Yes, and I'm not an engineer. That would be a step too far for me, but we use what we call slick water fracks now, and largely we pump a lot of water down the hole to create these fracture networks. Good news is that it's water, and when it flows back, sometimes it has things that we have to remove from it, or through evaporation and other things, before we can put it back into surface water. But it is largely water and sand that we're using.
Yeah, that is definitely an amazing, one of the great stories, I think, of innovation, within the United States, is really watching how the oil and gas industry has changed. And a great book that Jay had actually recommended was called The Frackers, and kind of follows the stories of those early gentlemen and companies that really started out looking to do something different. And boy, did they, boy, did they ever. So yeah, very interesting, Mark. And yes, I'm thankful for a country that does have capitalism. I mean, there's great countries all over the world. I still consider myself a Kenyan, but I would have to say, when you have a national, your government runs your energy sector, very different story on how that's going to look for everybody's daily lives. Very different. So we have a very unique opportunity here to produce oil and gas in this country and really support our own energy infrastructure, which is truly amazing.
Hey, Mark, I've got a quick question for you, if you don't mind.
No, Rex, be careful.
Up until 2016, there was no LNG plants in the U.S. Of course, the very first LNG plant was Sabine Pass in Chamberlain Parish in Louisiana, and it started with a 48 export terminal in 2016. And prior to that, all of our gas was stranded here in the U.S. And now that has expanded to where we have roughly 8 operational LNG plants here in the U.S. I'm sorry, in the continental component. Of course, we have in Alaska the Kenai LNG plant, but comment about LNG in the U.S. and how we have been able to capture the value of the natural gas from your perspective by the development of these LNG plants?
Well, fortunately, we have lots and lots of natural gas, and partially because of the fact that we have a lot of hydrocarbons coming out of what we call the Carboniferous, which is particularly conducive to generating natural gas because of the nature of the source rock. And that probably could be contentious. But at any rate, that's sort of a simple answer. But I will say, I've only been tangentially related to this, but one of the companies I worked for in the past, Pacific Enterprises, they actually were putting in or trying to, back in, what year would that have been? Probably 95, 96, maybe. They were actually trying to put in an LNG export terminal in the California area. And they put, I can't remember how many millions, hundreds of millions of dollars they put into developing the plan. And what was driving that was the idea that we could bring gas out of the Anadarko Basin and sell it on a worldwide market for substantially more money than we were getting locally from the Anadarko Basin. And so they started working on that. But as you know, in this business, sometimes the economics drive it, and plus governmental regulations are really also a challenge. So, I don't think it's a coincidence that all the terminals domestically are popping up along the Gulf Coast. A lot harder to put one on the East or the West Coast. The first, interesting, even when I was a graduate student, I remember flying to Woods Hole, Massachusetts for a meeting, and flying through Boston, and they shut in the airport because an LNG terminal there was created taking in LNG, bringing it into Boston. And I think that's still an active situation. But in those days, they actually shut down the airport every time an LNG tanker came in. And I just happened to be victim of missing my flight because of that one time. So just interesting tangent, something that I wouldn't have not known anything about if I hadn't been involved in it like that. But
yeah, America it's one country, but it's a huge country, and depending on where you are, you're going to have very different opportunities for energy or oil and gas production. And yeah, Texas and the Gulf Coast definitely very friendly to the whole energy sector. Very friendly.
What's really funny is I worked for a company and we had a drilling contract where we had acreage in Trinidad and Tobago, and Atlantic LNG has the second world, at the time, had the second world largest LNG plant. And they were shipping the LNG from Trinidad and Tobago to Boston to run all of the electricity there in Boston. So I think that's kind of a funny analogy.
All right, Rex, before it gets too late, we have to shift off to the LNG topic so that we can talk about tax, because even though it's July, we like to make sure that people are still thinking about early on planning, assessing, having their strategy down, making sure they're understanding what their options are. And of course, at King Operating, we provide value to our investors through tax deductions, through monthly revenue, and the opportunity to participate in a unique model in oil and gas that really maximizes their investments. Of course, if you want more info about that, please visit our website, kingoperating.com, click learn more, and we'll get some information to you. But Rex, I have some questions for you. I literally said, find the hardest tax questions for Rex. That's what I Googled. No, I'm just joking. I don't think there's a question that's too hard for you, Rex, but here's number one. Rex, what's the difference between a tax deduction and an actual investment return in an oil and gas deal?
Well, first of all, of course, for the actual investment component, you have to know what you're investing in. And so what you're really striving to do is to acquire an oil and gas mineral working interest. But the uniqueness of that statement is what type of oil and gas mineral working interest are you actually acquiring by your investment? What we have found is that there's really two forms of working interest acquisitions. One working interest acquisition is where for a group of oil and gas mineral leases, you own every component of how the decision to drill and where to drill is granted to you as a working interest owner. The second working interest assignment that we've discovered, or actually we used to conduct our business this way, but we don't conduct our business this way anymore, is what is referred to as a working interest wellbore assignment only. And if you look at how oil accretes value, how is oil valued? Well, oil is valued based on the pronouncements and various procedures that are discussed by the Society of Petroleum Engineers, or the SPE, or other similar international organizations. But the simplest definition for the classification of oil and gas and how it is valued is the SPE's comment about the 3 Ps. Well, what are the 3 Ps? It's proven, producing, probable, and possible. So in a oil and gas wellbore interest only, what you truly own is the proven producing component only. So whatever the wells that you acquire or the wells that you're about to drill through your investment, what you own is the hydrocarbons, the natural gas liquids, and oil that is produced by those wells. Any other accretion of value that you might have in the development and proving up the geological and geophysical components and improving the value of that leasehold, you don't own unless you own 100% working interest, where you accrete all of the value of the development of those oil and gas leases. And that's really one of the true measures of a true oil and gas investment. Now let's talk about the income tax. What are you striving to do? What you're striving to do, of course, is to acquire a deferral or a reduction of your current year taxes that you're paying. So oil and gas investment, because of the creation of intangible drilling costs and allowing with the big beautiful bill passing the ability to expense 100% of the tangible costs by claiming bonus depreciation deductions for drilling a well, is you can generate and accelerate deductions in the current year to reduce your other forms of taxable income. So for instance, if your gross income is $500,000, and if, depending upon the amount of investment that you make, you can somehow take deductions and lower that 500,000 total income to whatever you really want it to be, depending upon the amount of working interest that you acquire. So in that example, for instance, if you invested 200,000 and you invested in one of the King sponsored programs, more than likely you would generate approximately 80 to 85% of your capital contribution as deductions. So just to make the math simple, let's use 80%, which would be 160,000. So from 500,000 total, 160,000 deduction from that lowers your total taxable income to 340. So obviously you can see that is a benefit, and it's probably going to generate somewhere around a $60,000 tax savings in that very, very simple example. And what is the government targeting? The government is targeting anyone that really makes over $250,000 a year. And the way they target that, of course, is they charge the net investment tax of 3.9% on any earnings over and above the 250,000. So what you're trying to do is by claiming, by participating in an oil and gas investment, then you're reducing your overall taxable income. And I said 3.9%, it's 0.9%. Please excuse the error there.
Perfect, Rex. No, that's perfect. So, all right. Next question is just giving some advice here for, say, what would be a few good questions that an investor would want to ask their CPA about before investing in oil and gas?
Well, two of the major considerations of the big, beautiful bill is, of course, one I've already referred to is the ability to expense 100% of the tangible costs used in drilling by claiming bonus depreciation. So that is you don't have to ask about that. That's going to appear on your K1. However, the second component really should be an issue. The big, beautiful bill made as permanent the excess business loss deduction, or commonly referred to as the EBL. So for married filing joint, you can only claim up to $512,000 worth of business deductions if you're doing this for investment purposes. If you're married filing singly, it's only $256,000. So the real question to ask your CPA is, if I look at all my taxable income and I'm making an allocation, I want to determine what my business income is and what my personal income is. Only the personal income is going to be subject to this EBL limitation. So if you have business income, then the EBL doesn't apply to that. What applies is your personal income. And by definition, just in general inclusiveness, personal income really refers to as pension income, distributions from IRAs, W-2 income, or any form of portfolio income, which is generally interest, dividends, short-term capital gains, or long-term capital gains. All of those forms of taxable income are going to be subject to the EBL, or the excess business loss deductions. The second major question is that what you ought to ask your tax advisor to do, if at all possible, is to basically do an income tax projection and try and determine whether or not you're going to be subject to an alternative minimum tax liability or not. Because in very, very rare instances, on line 2T of the 6251, which is the form that calculates alternative minimum tax, IDCs may or may not be a preference item. And you want to make sure that the computation of the excess IDC, which is required to be reported on line 2T of the 6251, doesn't increase your alternative minimum tax liability. So if you model that and are discretionary in how you want to make your oil and gas investment, you can prevent that that incurrence of an alternative minimum tax liability. Those are the two major components: is EBL and alternative minimum tax liability that you want to avoid.
Thank you, Rex. And again, if you guys have questions, if you have tax questions, you can always shoot them over to Rex. He'd be happy to answer those. It's rgifford@kingoperating.com. And again, reach out to us if you'd like to learn more about King Operating at kingoperating.com. Scroll to the bottom and click Learn More. There's also the opportunity to check out Jay's book, The Upside of Oil and Gas Investing, published by Forbes Books. We would love to get a copy of this in your hand, share more about our story and exactly what we do here in oil and gas. That is very unique to this space. So I want to thank you, gentlemen, for being on with me today. Thank you so much.
Thank you, Rachel.
Thank you. Appreciate it.
Thank you.
Bye.
Thank you, everybody, for watching. We'll see you on the next Oil and Gas Rundown.